The mergers and everything are a big part of what we've seen throughout 2024. So it has us all thinking in the land community, okay, what's next?
A lot of these transactions, whether they're private equity backed or the merger of equals, a lot of what we see from the midstream perspective on those types of mergers is a checkerboard pattern of crossed over dedications and midstream capacity.
You've had kind of a consistent diet of kind of large scale mergers going on in the market, and especially we're talking about the upstream market. A lot of it focused on the Permian, but not all of it. And, some of them are still waiting to close, like Chevron and Hess. But as these companies consolidate and get bigger, they're seeking out efficiencies and cost savings. And they're also going through a reprioritization of their inventory stack. And so some of that's taking a little bit longer. There's a lot that goes into a lot of these large scale mergers.
Land insights, market trends, industry experts. Welcome to the Land Department Podcast, the state of land and energy as we see it.
Brent, I'm going to be in over my head. We're talking about everything that happens after the mergers. I'm going to learn a lot today. I think our audience will too. What do you think?
Yeah, well, I feel over my head pretty regularly as well, so don't feel bad. That's why we've got these guys. We got the pros on the call today. Austin and I met really over LinkedIn. I saw an article that he was involved in, reached out to him. The mergers and everything are a big part of what we've seen throughout 2024. And so it has us all thinking in the land community, okay, what's next? How do these, we know we're going to have a lot of transactional stuff. We've seen that come to life post merger. And so I reached out to Austin and said, man, I'd love to have a conversation with you. John is a partner of his there at the firm at Bracewell. So he asked if he could jump in. I said, absolutely. The more, the merrier. So guys, welcome. Thank you for joining us.
Yeah. Thanks for having us.
Yeah. So we're recording this in December. Obviously, this is going to go live in January sometime. So maybe the information will change a little bit about what's going on. But why don't you give us a lay of the land, guys? What's going on these days?
Sure, I'll jump in there. You've had kind of a consistent diet of kind of large scale mergers going on in the market, and especially we're talking about the upstream market. A lot of it focused on the Permian, but not all of it. And those have been, some of them have closed, some of them are still waiting to close, like Chevron and Hess. But as as these companies consolidate and get bigger, they're seeking out efficiencies and cost savings, and they're also going through a reprioritization of their inventory stack. And so some of that's taking a little bit longer. There's a lot that goes into a lot of these large scale mergers. And so it's not like a immediate reaction, but I think the trend that we're seeing and hoping to continue to see is this kind of churning out of reprioritization of that inventory and finding the right home for it to the extent it doesn't compete with other items in the newly consolidated entity. And so we're seeing a lot of that. We're seeing people coming back into the upstream space generally, just after the lost decade, so to speak, of not focusing on growth at all costs. Companies have done a pretty good job since the pandemic of focusing on cash flow and living within their means and returning money to shareholders. And so that's tempered the growth a little bit, but it's invited interest back into the space from investors. And so we're seeing different types of investors looking at it. There's still, some ESG focused folks that aren't interested, but we are seeing capital return to the space in a number of different ways. So that's exciting. And I think that, you've seen some of the private equity funds raise and close funds that are now going to be put to work in the upstream space. So we're looking, I think they're going to be the recipients of a lot of this, asset digestion from the consolidation that's occurred. And then you're seeing other models to come out and buy assets and start companies. John, why don't you kind of fill in on some of the things?
I mean, a lot of the same in there as well as the midstream space, and it's just the types of deals that are getting done in the latter half of this year have been sort of the follow-on transactions from some of those bigger mergers. And so more recently, we've seen kind of a resurgence of acreage trades or maybe farm out type structures where it's bringing in these different types of capitals, whether that be family office money, um, or smaller, maybe new management teams from a private equity company, who maybe don't have as big of a commitment, but are going to go take down a single pad and kind of prove that they have um, the knowledge and the experience to operate a larger company. And so we're definitely seeing a lot of that happen, which is exciting because it's kind of begets what maybe is coming in the future. Um, and from that, there's a whole host of things that, we get calls on to assist with.
Tell us a little bit more about the family office aspect of it. I'm really curious what's different about that and the role they play.
Sure. From at least from what we've seen is, whereas maybe in the past, the family offices and maybe still are, right, are limited partnerships or limited partners in private equity funds. Now, there are, you know, family offices who are taking a slightly different approach, and they want that direct exposure. It, but whether that be as a non-operated working interest or to directly invest in minerals, but they're just hunting for that yield in a slightly different way with a little bit more hands-on approach. And so we've seen that. We have some friends of mine who are also clients, Buffalo Bayou Resources. They go out and kind of put some of these opportunities together, and really assist family offices in looking at these types of things and underwriting them. And there are other banks too. I know like the Ten Oaks guys. They really help underwrite these types of things, in addition to their brokerage business. But it's just as the capital, it's not like a big secret, right? That there's less private equity money. In the past couple of weeks, we've seen Quantum and NCAP come out and announce, and NGP announce large. I don't know. I guess NGP hasn't announced yet, but I've heard that they will be announcing. That they're closing a fund. We haven't worked on it, so nothing to disclose there. But it's just different types of capital now that are finding its way into the space, kind of as Austin pointed out.
Yeah. How do you see that? I mean, what is the significant difference? Austin referenced earlier, we went through a season in our industry where it was just throw money at projects. Sometimes we worked projects that just didn't make sense. People weren't as prudent with their investments, as we've seen post-COVID. What do we anticipate seeing? We have that shift in mentality. It's, let's make sure we make money. Let's make sure we've got a return. How do you see that continuing to progress? Do you think we'll stay along that more disciplined approach, or do you see indications that, with administration and economy and all the things that may or may not happen there, do we see any change in that mentality?
Yeah, no, I think that mentality is very much alive, especially at the public company level. I think that, investors, we as an industry needed to earn that trust back. And they've done a great job. I mean, companies have been incredible stewards of capital and have really, really done a great job of living within their means and trying to grow in a calibrated way. It will be interesting to see how these different investors, like the family offices, have a very different cost of capital than, some of the other, especially if they're investing directly versus, having a promote level from a private equity fund. I don't know if that makes, certain projects more investable for that group, going direct than going through the PE route. But, at the same time, it's, PE serves a great function in aggregating capital to be able to do material deals. And they do a lot to, screen investments and find teams, and they bring a lot of value to the table too. So I think, maybe there's a bifurcation in certain, levels of transactions that can be done directly by some of these investors. But I do think that living within cash flow, at least, for material companies is going to, and especially for publics, is going to be very important. And then you have a different demand dynamic around the world. I mean, that's going to impact pricing. That's going to impact what kind of deal structures people use to do transactions and what transactions can get done based on the basin and based on the cost in that basin.
Yeah.
We're also seeing family offices and just come in a slightly different, as opposed to just a pure, with a private equity backed team. Instead of them, maybe they can't go get a traditional credit facility, and we're also seeing family offices look at a way to try to provide sort of a private credit product to bridge the capital or bridge the gap between the equity dollars they can draw from their private equity sponsor, and then until such time that they have production online and can put in place a traditional credit product.
Yeah. So I guess we kind of jumped right into what's going on today. Maybe I'd like to step back and learn a little bit more about how you guys fit in, what you specialize in at the firm there, and you guys in particular. I think that would help give some context. Also, maybe tell us about what you do, what types of clients you work with, and who you're working with most recently, what are interesting kind of transactions that you're dealing with and seeing. Maybe give a little context to everything we're talking about.
Yeah, no, that's fair. So John and I are both, we work hand in hand, but we're in part of the same group, which is, the projects group here at Bracewell, focused on energy transactions. A lot of that is, what people would call traditional energy. So upstream, a lot of midstream, M&A, A&D. And then on the midstream side, we do M&A, and then, all the commercial arrangements, gathering and transportation and processing, and even, downstream to some of those facilities as well. We also do joint ventures, especially in the midstream side. But we deal with everybody from the typical private equity portfolio company up to independents, public company independents. We don't do necessarily quite as much work from the majors, but we're across from them all the time. Especially,
You're dealing with them.
we're dealing with them all the time. But a lot of us have land backgrounds as well. And for those that don't, we value that. It's an incredibly integral piece of what we do in advising clients in the upstream space and the midstream space. And that's a lot of our team has a land background, either as part of their education, after law school or before. We do everything from large scale macro farm outs and JVs at the asset level down to multi-billion-dollar M&A deals.
Awesome. I understand, John, you tend to focus more on the midstream side of things, and I'd love to dive into that.
Sure.
What are you seeing? So, I mean, obviously, we have mergers that moves the headlines, but there's always a midstream component in some shape, form, or fashion. What's the landscape of the midstream space? Post merger, what do you expect to see? How are you guys involved? What are some of the challenges that you maybe deal with in these types of tag along assets that come through a merger?
Yeah, I mean, and a lot of these transactions, where a company is going out and acquiring either whether they're private equity backed or the merger of equals. A lot of what we see from the midstream perspective on those types of mergers is, a checkerboard pattern of crossed over dedications and underutilized midstream capacity, or maybe there's too much overutilization in a certain area. And so there's always a large task after a large M&A deal where the surviving company is figuring out, okay, where are we dedicated? Sometimes it's, hey, we've got two dedications in the same area of land, which one takes precedence, and when does that obligation burn off, and what happens after that? Do we have to ship all of our barrels or our gas to this other provider? And that is something we've been involved with very intimately on several of these transactions after they've closed.
So does that tend to be contractual? I mean, is it a matter of just looking at which contract is going to supersede, or is it determined by who the surviving company is, or who the parent
It
company is
can,
gonna be.
there's a whole host of factors. And many times too, the midstream company will say, look, we don't, sometimes there'll be two different dedication agreements, within the same area with the same company. And, for one reason, maybe the producer wants to, utilize a certain contract because it has more favorable terms, and they'll want to utilize another contract over here because it has more favorable terms. And so when that happens, what I tend to see is both parties coming back to the table and maybe having an amended and restated agreement to cover a larger area where maybe, we'll sand out some of the sticking points over here, and you're going to, seed some ground over here so that we can have something that works on a larger, for a larger area. And that's also usually looking forward towards, if a producer wants to go develop another area and it's like, hey, midstream company, what are you going to provide me by way of, build out obligations and, giving me flow assurance for this area that, that is now risen to the top of the stack of where we're going to go develop in the next, 12 to 18 months.
Yeah.
Yeah. Another thing that's kind of similar to that, if I can jump in, is like that's kind of looking back after a merger's happened. A lot of the time, once one of these mergers happens, you go back in, you kind of look at what you need to sell out. And let's say you're selling out an area. Well, sometimes, those agreements that maybe you inherited don't provide for a clean ability to assign acreage that's dedicated to a midstream company and prevent, in a way that prevents your buyer of that acreage from only being dedicated with respect to the stuff it bought from you. Or maybe there's aspects of that like firm capacity or an MVC or something like that it's not really clear, it's stated kind of at a general level for this 25,000 acres that's dedicated here for this one producer. Well, now if you're lobbing off 15,000 acres to producer B, how much of that MVC goes with it? And that's always going to require, if it's not pre-baked into the agreement, you're going to have to go back to the table with the midstream company and kind of iron that out, to make sure that it syncs up with the economic deal between producer A and producer B.
What are your recommendations typically with that, Austin? Do you encourage your clients to try to pre-bake that into their deal, or do you feel like it's better to have an opportunity to sit back down at the table and renegotiate those things?
No, we try. I mean, from the producer side, we try to pre-bake it in there, to basically just say, look, we're giving you an MVC, midstream company, and as long as you get that MVC, it doesn't really matter how the pie is sliced, as long as there's an adequate assurance of performance that kind of allows the midstream company to have, an assurance that it will be made whole, either through an LC or parent guarantee or a certain credit rating. But yeah, we try to, when we're negotiating one of those agreements, we try to take into account, any aspect of that. You've got to be looking towards the exit and how that, what ability does that upstream company that you're representing have to sell acreage subject to this contract and kind of get a divorce such that their buyer, kind of has an independent relationship with the midstream company, and you maintain what you want to maintain with that midstream company, because that's the deal you cut. And, it can be a good deal that, can make a piece of that acreage, more valuable if you're trying to sell off and get more for it. So we try to be thoughtful about that.
Yeah.
Another piece in the midstream transactions, and this is more related to when a producer, an upstream company sells their midstream assets. An issue that we run into a fair amount is, and when we're representing the producer who's selling it, or you're representing the midstream company who's buying it, is the rights of way and surface rights that the pipelines are laid pursuant to. And many times, whenever an upstream company is developing, whether it's a water system or a crude system or a gas system, they may be laying gathering lines just pursuant to their oil and gas leases. And when they go to sell that, segregate and sell that system, they'll actually need to go and obtain, standalone rights of way. Or if they've laid co-located lines on a state or federal right of way and trying to bifurcate those and sell those, you quickly run into a whole host of issues that if you're not properly accounting for within, either obtaining new rights of way before closing, or, having, if it's a private landowner, making sure you have the consent to bifurcate that prior to closing, it can leave the surviving company or the midstream company who's purchased this asset, unable to, operate the asset, or, leaving the producer subject to a breach of rep claim, that the buyer can't operate that asset in the same capacity that they did prior to closing.
Yeah. We've, on the land side, we've of late, the last 4 to 6 months, had a number of clients reach out to us about their midstream and this with the same scenario. Hey, we've got this. We're looking at packaging it and divesting of it, monetizing it. They've spent a fortune, right, on mergers and buying assets, and now they're looking for ways to bring back some capital. And we do a lot of that. It's a gap analysis, understanding what's on a lease basis versus what's an actual deeded right of way. One of the things you mentioned, you nailed it, is how much, do I have lay flat in a road right of way, right? Well, that's not as easily conveyed as, the law easement. So we're doing a lot of that stuff. We also see quite a bit of late discussion and preparation for mineral assets, right? Companies that have their own, fee mineral interests through either a mineral buying program or whatever. They'll spin those off into kind of standalone asset bases, and doing a lot of prep work to organize that, to either be able to monetize it or take it public or do whatever. All these kind of unique projects post-merger are starting to show themselves. And that's where you can kind of really get an opportunity as a land professional to take that big picture understanding and your due diligence hat and put it on for a seller, like more of a seller's due diligence. How involved do you guys get in that kind of post-close activity? Your merger's done. What's been the most active for y'all as far as transaction types and deal types that your clients are asking for support on?
Sure, I'll jump in. I mean, right after we recently assisted a private equity-backed company in a series of acquisitions, and to your point, one of the first things they wanted to do was set up a mineral sidecar. And, we assisted them with the tax advantage ways to set that up in Texas, and then making sure that they had the proper procedures in place to be carving off those overrides on their leases that, may have had additional NRI above 75% that they could push over into a sidecar vehicle, and making sure that they had the systems in place and their team were comfortable that they could do that all along the way, so that you don't reach a sale point and you're trying to do it then, for tax reasons that, probably outside of both Austin and I's, immediate practice area. If you carve off an override in the context of a sale, you have some pretty disadvantaged tax outcomes where you reclassify everything into ordinary income. And so setting up this process where you're going along and doing this as the ordinary course is important. And you also need to think about, as you bring production online, making sure the client understands, whether or not they want to have the assets of that mineral sidecar pledged under a credit facility, or if it's going to be outside that credit facility in case they were going to exit that at some other point.
Yeah, I mean, the other types of, things we do for clients who are pursuing a sale is, usually we sit down and say, okay, do you have any of these, where are your dedications? Do you have any MVCs? We kind of go through the litany of things that we talked about that can cause issues on the midstream side, and just help them assess that. And sometimes they want us to look through the contracts and kind of map that out. Many times they have their own team and they're very familiar with it. But, just helping them understand exactly what they're under on contracts, midstream, restrictions on, if they have a development agreement, there may be obligations that they're going to have to line out for a buyer that the buyer's going to have to step into. Really, it's more on, what's in these contracts, consents, pref rights, how does that all fit into the picture? We help them usually on a kind of case by case basis. If they know of something up front that's potentially a title issue or could be interpreted that way, we kind of look at that and poke holes in a lot of the different PSA provisions that they're likely to, see from a buyer and just say, okay, well, look, this is how this is. And, this is how whose responsibility is probably going to be. But, we don't go in and do a land review. That's what you guys do. And, we work hand in hand with either the in-house or, a contract land team, for the asset that's being sold.
Yeah. I mean, it's very much always a consolidate when you have these transactions, either, pre-transaction or post, it's a consolidation of skill sets and information. And that's what we always encourage for access to the legal team. And, the more understanding we have of what we might be facing from a contractual, standpoint, these things are very sophisticated. They can be very complicated, but the more informed we are and the more access we have to a team like you guys to understand, okay, on this deal, these are some things that we need to have on the radar because of that big picture analysis. It informs us, makes us much more prepared to be able to just trigger those things when we see something that could trigger that. I think that's the most successful deals that we've been involved in are the ones where you have that collaborative experience and can work together with the team in-house. So, always like working with guys like you that really understand what's going on and can advise the in-house team on things as well. What's the next 4 or 5 years look like? Guys, what do you expect? What are you expecting? And from, we've got the mergers. We're starting to see transactions. Obviously, we've got end of the year stuff. We're very busy doing due diligence across the country. We're doing Eastern States projects. We're doing stuff in the Rockies. I've got a couple of Permian deals. We're doing a Haynesville right now. So very active in those transactional spaces. Where do you expect to take us or expect the industry to go, for the next couple, 2 or 3 years?
I mean, yeah, I'll jump. My thought is I'm going to be careful not to I've kind of learned to not try to predict too much because you never know what's coming down the pipe. But I mean, one of the things that we could hopefully see down the line is, gas assets hopefully coming back into the picture. And I know the supply side of that is problematic for pricing, but you've seen some changes in Chinese demand switching over to like LNG fleets rather quickly. And, that's hurt crude oil demand coming from China and kind of maybe makes the case for gas. And, obviously, with the new administration, if the LNG pause is removed, that, could really help things as far as, having an avenue to get to markets, or to expand that market. We already have a lot of LNG that's already under permit, but, that would be a bright spot if we could get some of the gassier basins, up and running and having a lot of M&A interest. I think you still see some consolidation, but then, maybe that whole kind of portfolio optimization act is going to go on. And that should hopefully provide opportunities for new management teams and new investments in these projects and, people who have a lower cost of capital who can make projects work in these different environments that we're going to see.
Sure. I mean, similar to Austin, I could mimic, repeat things on a macro level that I've heard or read in other magazines. What I've seen at least firsthand is, the new teams that are out there or teams that, have a proven track record and are re-upping and going at it again are, moving into what, maybe was considered tier 3, maybe now considered tier 2. But because they have that experience and to Austin's point, the lower cost of capital, they can go pick off the hair of some of these, what previously were troubled assets. And maybe that's because there's new sour gas treatment facilities that have been constructed or, the geology is better understood in a certain area. And so on the smaller front, on the, maybe the smaller teams that are out there doing things, to me, it looks like that there's a healthy amount of inventory out there for teams to go and attack those opportunities.
I think we're seeing it. It's with some of the new funds being developed. We're starting to see private equity come back. I mean, some of our PE-backed clients are starting to talk to us. We hadn't heard from them in a couple years, on new activity, new deals, new transactions. So hopefully, I think we're all expecting that. I think in the land profession, natural gas is key. When natural gas is healthy and those projects are active, it's a big deal for us. It just opens up so much of the country, especially here in Texas and Louisiana and the Gulf Coast. So hopefully we'll get there. What, as let's dive into some of the transaction types. I know we talked about this leading up to our call. Maybe let's dive into 4 or 5 of the different type of transaction types, talk about some pros and cons to each, some challenges that we might face with each. I think the first one we had large asset sales, non-core, non-op, mineral divestitures, farm out transactions, and then we had a divestiture of midstream components and water assets. We talked a little bit about the midstream side of things. What about what are some things that some challenges, Austin, that you would try to navigate clients through on the large asset transaction side of things?
Well, one of the challenges that's been out there for a while is the activist FTC that we have, as far as really hammering down on antitrust issues in HSR. Not sure how that probably going to change a little bit in the new administration. Probably a little bit more friendlier to the M&A environment. So we'll see, but hopefully that's the case. But I mean, I think that with these you've seen. Like for instance, Oventive recently, they acquired some Montney shale assets up in Canada, and at the same time, divested Uinta Basin assets. So these big deals are happening, and sometimes it's selling off conventional assets in a large package and keeping things around it. That's that gets a little bit tougher if you're not doing a full exit from a basin. Because you have to bifurcate things like microgrids or water assets or midstream systems. You have to make sure that you can continue to operate what you keep in that basin. But all of these things are asset level issues: consents, pref rights, contracts that have different elements, like we were talking about, that need to be separated if they don't provide for that. So that whole litany comes in on either of these deals. I think that you also have some basin specific issues, whether that be, in Uinta, you've got BIA leases all over the place. You have state leases in New Mexico. You have, a little bit less regulatory, so to speak, risk in Texas. It's a little bit easier to do things, but you got the BLM. So, you can, maybe you have all of those things in certain of these deals. So, I mean, that's another element of, these transactions. They can take a while to get approvals. There's a lot of paper that needs to be done.
A lot of boxes to check. Yeah.
Well, we see a lot of clients underestimate, how much is required for that. But that's, really just more of the logistics of the transaction. But yeah, I think the large asset sales are kind of the first thing that these companies look at, because, they can really move the needle on paying back debt. The market likes it usually. If they're doing it, they have a reason for doing it, and they can, it's kind of like developing scale. They get bigger bang for their buck if they can offload a really good asset.
Yeah.
Yeah. To add to that, I mean, on large asset sales, you think about it. If the company is selling, if it's like a private equity backed company selling everything they own, then you may not have as much nuance around the edge of the particular asset. But many times we'll see a company that is maybe developing an asset, maybe in the Permian, maybe in Texas, and they have also developing something in New Mexico, and if they want to exit those separately, from a land professional's perspective, you have to think about what if they're right near the border and there's things that are going to cross over between them. If there's a contract that you're going to need a shared use agreement, those are things that, when we're sitting down for that initial meeting with the company saying, okay, you want to sell, have you thought about X, Y, Z, so that, we can craft the PSA to, address those issues ahead of time. To Austin's point, if there's a lot of state leases, in Texas, maybe not a big issue. due to recent, changes in New Mexico, there's maybe some extra steps that you want to anticipate and build into your documents ahead of time. But there's, things are always changing. And so, you hear about something on a deal and there's, okay, next time,
Yeah, I got to think about that. Yeah.
Yeah. And that's also, I mean, sometimes land professionals, many times they're going to have, the first inkling of something. And so, having them in those meetings ahead of time say, hey, we know,
You can think about
and maybe
there.
it's something just about a particular landowner. Hey, we're not going to get this consent. This guy hates us, right?
Yeah.
And so what we need to do something about this so that, when the value falls out because we can't get this, it doesn't blow up the whole deal.
Yeah.
Right. And if no one knows that, it's something that we need to have flagged ahead of time.
Yeah, let's kind of dive into that. I think that's interesting. It's the conversations that you have with your land teams as you're preparing for these deals. Let's kind of just walk us through that. I don't know that I've got a structure, but just like what are those conversations? What are the questions you're asking? What are some of the things that would maybe be good information for my counterparts in-house to just happen?
It depends on the size of the company, whether we're involved in those conversations or whether that happens internally and that information is presented to us. Smaller companies where the head of land is kind of on the deal team, we're maybe being a little more proactive in asking those questions. On larger deal team, larger companies, right, where there's several layers and divisions of and it's an asset that spans multiple counties. It's just not practical to have all those people in the room.
Yeah.
But having the systems in place and where I've found the transactions sign and close with the most ease is where there's a very organized land department that whenever you're producing, hey, we need these exhibits, with the net acres, NRI figures, APO, BPO figures. Oh yeah, boop, boop. And it's spit out in no time. Where sometimes we run into issues is yeah, let us go work on putting that together, and it's maybe those files weren't in existence until we asked for them, which that can or we drafted the PSA a certain way for the tile defect mechanic to work in such a way that we're going to defect based off of a DSU. And then the land exhibit that's come up is constructed in a completely different way.
Yeah.
So then we're going back to the drawing board. Okay, do we want to redo the exhibits? Do we want to redo the PSA? Getting ahead of that just saves everyone a lot of time.
Yeah, I think syncing that setup, especially on the title mechanic, up with, the way that the seller has represented the asset to the buyer, and in turn the buyer has allocated value and the way that they've been thinking about it. I mean, the agreement and that mechanic are there to complement the assumptions that the parties have made, at an economic level. And I think that, explaining that, I mean, we've had to explain that to land teams that are going in there on the buy side a lot of the time to say, okay, now here's how this PSA works.
Yeah.
You got to do it on a DSU basis. And this is how this, kind of all fits together. Yeah, I think that's a big one for sure.
Yeah. That's one of the things that we end up diving into first and foremost when we're approached about supporting a client with due diligence is, okay, I need the PSA. I need at a minimum, I need a summary of the PSA. I need to understand how value is allocated on your side, how defects are structured, what are the thresholds? All those things are super important. And what we find oftentimes is there's opportunities to assert defects, but the PSA was drafted in a way that makes it impossible. And sometimes the reality is that this deal is going to get done. Due diligence just has to be done to check a box, for either from a lending standpoint or whatever. And it's got to be a significant defect to really move the needle. But those are all questions that as a landman, you want to be asking. If you're a project manager on a due diligence team, you need to understand, okay, what got us to here? How is this deal structured? What's the PSA set up like? What are those specific nuanced things that you know of that you may have learned through those negotiations that we need to be on the lookout for? All those things are like big parts of how the mentality you take going into your due diligence.
You can create a ton of value in a PSA, right? Just the way you describe assets, the way the title defect mechanic works. I mean, we worked with a client who was acquiring minerals from large operators for a long time. And, this was probably back in 2016, 17 era, kind of before the sophistication really came into the minerals market at least what exists today. And, in those PSAs, we're just buying everything, any kind of mineral override, NPRI, anything you own in this county. If we go look at, can we do countywide conveyances? And, you talk to him a couple of years later and he's like, the amount of just Easter eggs we found because of that approach is just amazing. Like, we bought that deal for X and it was quickly a 4X because of all the stuff that
all the stuff
they didn't know they owned. And we found out that we now own.
Yeah.
Yeah. But on the
other side, you want to make sure you're, on the buy side, that's great. On the sell side, you want to make sure that, okay, we're showing you what's listed on the schedule, right? It's not, it's not everything inside the box.
Well, and I think that, this, and it kind of goes into the second little bucket a little bit of, that list that you said, Brent, but the, on these smaller deals where you're carving off a piece of something or it's, trading acreage or something like that. I mean, oftentimes from the sell side, you're looking at making sure that what's excluded is the right stuff. Like, let's make sure that we're not giving them our overrides unless they're listed on this, schedule. Or if a seller or if a buyer takes the approach of like a sale area, like John was saying, where it's everything in this box or this county or whatever, let's make sure that we reserve the overrides and the minerals or the leases or, wellbore interest, et cetera, that we want to make sure that's described somewhere and how the PSA works. And so really just educating them as to how the document is configured and how it works and doing that early enough so that, when you're not on the phone with your client, they already kind of understand the setup and they can be like, you know what, I don't know if this is covered. I need to ask the question to the legal team or to within the land team and say, okay, let's look at this a little bit harder to make sure that we're not doing something we don't intend to.
Yeah. And what is it recommended? Like, at what point in time do you guys like to be involved? So say, you've got a deals team in-house and they're starting to frame out the discussions with a counterpart to either buy or sell. At what point do you guys recommend getting involved? When should an in-house landman, or that team be reaching out to their counsel to start helping frame out the PSAs and things like that?
I think it needs to be pretty early because, I mean, a lot of the time it comes down to, are we selling the assets or are we selling the entities? And, that discussion may be framed by what kind of transfer restrictions that you have in the underlying contracts or in the leases or whatever. Sometimes you can get around those through an equity deal. But then also just, we don't have to be grinding and cranking on documents necessarily, but going through this checklist of questions that we have about midstream, all the things we've been talking about today, structure of the, how are y'all thinking about title? Are you going to be, representing, are you going to ask a buyer to allocate value to the PDP stream and then the balance to undeveloped? Are you going to be limiting it to specific target depths? All of those things, if we can think about those ahead of time, it allows us to, draft an initial document, move quicker, move with a little bit more intention. And that serves everybody well as the process gets going, because we all know what happens is, some number gets thrown out, everybody gets really excited and it's go, 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 go. And, and that's part of the deal. It's fun, but it's also like, part of it allows us to do our job a lot better and our clients receive a lot better service as a result of that.
Yeah. I always tell my clients on the due diligence front, call me as soon as you have an inkling that you might need to be doing something. It takes time to allocate resources. And frankly, when I know about it, you get free brain time because I'm just thinking about it. It's there. My mind's working and I'm not reacting to like, all right, what's in front of me? I got to go tomorrow. So the more proactive a client can be with reaching out to their support teams, whether it be on the legal side or on the land side, the better. The earlier, the better is our MO. And you get that free brain time. I don't know if attorneys give free brain time.
And I think that's probably the hesitation, right, to reach out. It's like, God, as soon as we reach out, the meter's just going to kick on. But it's I didn't make this up, right? There's cheap, fast, good. Pick two.
Yeah.
On a deal, right? But when you bring in a team, like a group, an outside counsel to assist you, and it's the last minute, you're probably gonna have to bring in a lot more people to just cover off on everything, and make that fast deadline. Whereas opposed to if you brought in someone earlier, it's a smaller, the right people who can work at a more normal pace. And to Austin's point about those questions, it's like, hey, let's make this game plan and get this doc ready so that we're not finding out, once we already had served up a doc that, oh wait, there's this major issue here. We haven't accounted for it, and we're posting this doc to a VDR tomorrow. And just avoiding things like that in the end are going to cost real dollars from the purchase price, as opposed to maybe a couple extra hours, had you picked up the phone, a few weeks earlier.
Well, and I think the other thing on the cost side of that is the credibility that you have with your buyers. If you go in there and it's not coordinated, and it's like, wait a second, this doc doesn't match the way that you guys represented value in the data room. Like, what are you asking to do? That doesn't sell well. And that's what we try to avoid. We try to be as efficient as possible with our clients. But I mean, when you present a very collected and thoughtful picture that syncs up with what's in that VDR and the way that those conversations with your buyers have been going, the deal flow of that negotiation, it just works a lot better.
Yeah.
The other thing is, I mean, we're very fortunate. We have a lot of clients where we've helped them, buy a majority of the things, the assets that they've purchased, and then we help them on the way out. We know our clients' assets quite well in a lot of cases. And if we know something's going on, even if it's not even hot and heavy, even if it's coming next month or something, things that we're doing for other clients and other works or deals that we see in the market. I mean, that can just sit in the back of your head and be like, oh, okay. Yeah. That might relate to where these guys go. We need to be on the lookout for that.
Yeah. Like I think to Austin's point, so there's been a couple deals recently where we're representing, a seller, and the person they're selling to now has recently bought, and they have a PSA that's public out, and we've pulled it and we've already dissected it. And it's like, oh, by the way, they gave on this, and this.
Yeah.
In this deal a couple months ago.
Yeah. There's some strategy there as well. So that makes a lot of sense. What are some of the cautionary tales? Also, you mentioned, when you aren't as prepared, or your VDR, and I'm just referencing VDRs because it's so land centric for us. It's an important part of what we do. We see very, very often where, this PSA is drafted, everything's good, and they said, all right, go, we got 30 days. And it takes 14 days for us to get access to the files. And time and time again, the PSA has no repercussions there, right? We still have to close in, 30 days. What are some of the things that you see that you try to account for from a land due diligence standpoint in your negotiation support?
Yeah, almost all the sophisticated PSAs that you're going to see are going to provide the buyer with access and, remotely unfettered access to the records, maybe during reasonable business hours. And oftentimes today it's electronically. So you can kind of gauge the seller's ability to provide information as you're, up until signing. Because you're going to ask some questions, you're going to see the material contract schedule and say, hey, I need to know more about that. And if they are not organized or forthcoming or anything like that, I think that you can kind of get an idea of what you might expect, and maybe you can beef up the provisions. But there are cooperation covenants, and honestly, we don't, we see issues from time to time, but the land teams usually have a pretty good idea of what they're getting into by the time you sign a document, at least as far as what they think the seller will be able to provide versus not. So some of that is just kind of a a gut feeling going in, and we've had clients ask us to do, put in provisions that are a little bit more stringent, whenever they don't have as good a feeling about it.
Mm-hmm.
But ultimately where a lot of that goes is to price, because they're going to say, look, if I'm going to have trouble really diligencing this asset, I'm going to build it at a discount.
Yeah, there's a discount associated with that.
Yeah, it didn't really help the seller to do that.
Yeah. We see it pretty often. I think there's a little gamesmanship there at times, complicated assets. You'll get your files, and you'll get your exhibits and your schedules. And it's like, you got to spend a week trying to crack the code, how to reference leases to wells and all the things. So that's always, we always really push to try to get as early of access as possible, because it just there's an organizational period there to figuring out how things are structured, figuring out how to find your well files and your lease files, and tying all that together based on how your, if your value is on a DSU basis or on a well basis or on a lease basis, as a part of your deal. So we always push to try to get as much access as we can. And hopefully the PSA negotiations are such that it gives our clients some support to either extend the period, or, they're getting a discount for having to deal with such a damn mess.
Sure. I'll one other point, obviously the engineers and the finance team should be working on allocating value before you even sign the PSA. And, we're not involved, we, on the law side, we're just waiting for, the allocated value schedule to come over. In a lot of deals, you'll see things come to a pause when value has been allocated in a way that indicates they've been working very closely with the land team to say, here's where we know the defects are. We're going to put all the value there.
Yeah.
And then the whole deal just says, hold on, like, this isn't really where you think all
About
the
a
value
$20 million wealth.
Right. We know this is why, because you want to defect this. And, and then, there's a discussion amongst the principals at that point.
Yeah. What about water? Obviously in the Permian Basin, water is a big deal. We've talked about marketing. What are some of the, issues or cautionary advice for how to deal with your water systems and your water contracts and your deals there? Is there anything that are good takeaways for, an in-house landman who's maybe involved in this type of deal, whether on a large scale or maybe on a small scale? Let's maybe look at it from a small scale acreage trade standpoint, or, a carve out of an asset. Is there anything there that
I think there you just be, and I think Austin hit on this earlier, right? About, making sure that if you're going to do a trade and those two positions are dedicated to different companies, that, you have a release and rededication that's sort of agreed to at the time of the swap, so that you're not picking up a dedication to another company that, you don't intend to send water to. And in kind of in that same vein, if you, let's say you're not swapping, but you're just buying, hey, we're going to sell you this little, we've got 100 acres over here that we're not going to develop. We'll just sell it to you for like $2 million. You buy it, and that acreage was actually dedicated by the seller as part of a larger AMI, without, carefully making sure that you're just assuming the dedication as to that acreage. You have the potential to accidentally step into a much broader dedication
requirement
you never intended to. And so that's a big pitfall that, folks can get in a lot of trouble with really quick.
Yeah. We see that quite often. We get brought in as landmen to do leasehold verifications on acreage trades, right? I'm swapping a quarter for a quarter, on another section. And if we can do the title, right, and determine the working interest and override burdens and all those things in our eyes, but the ticket is the contracts, right? We always encourage our clients to give us access to the contracts that pertain. What are we dealing with here? Because that can factor into the whole picture, right? If this is this an apples to apples trade? Is this fair value for fair value? Yeah. So those are all things that we focus on as well.
I was also going to say on a smaller scale, on the water side in particular, if there are landowners who you have to acquire your on lease water
from me. Or if you don't, you have to pay, a 20-cent throughput fee for any water transported across my surface.
Yeah.
You see that, you see some of the Permian, definitely in the Eagleford. But that's, something that while you may say, oh, this is kind of right next to our position, but you may be picking up a new landowner you didn't know about.
Or a new partner, and or these aren't just landowners, these are partners,
Yeah.
development partners. They're very sophisticated.
I mean, one thing that kind of on the water side that we've seen recently is like a lot of the time, if you have a standalone water disposal system, oftentimes it's housed in a separate entity. And for, hopefully, like John said earlier, like do you have standalone rights of way? Do you have the surface fee interest that you need at the disposal side to inject that water? If you have those SWDs, or especially if you have a system that moves the water around, even if that's lake flats or whatever. One place where we've seen it cause some confusion was when you're selling an entity alongside a set of assets, and that entity sale often has a different set of purchase price adjustments, and it's really trying, like, especially if it's an affiliate owned water company, how does the fees that are charged by that affiliate, they may have some third party shippers on it or third party users, like how do those fees relate to the other assets being sold, and how do you separate that out? I mean, that we had a deal that caused some confusion on that, and it's just something to get up. It's really, there's an answer to it, but it's something that the parties need to kind of think about how they want to handle in the documents, how they want to handle in the valuation, and just coordinate that, as part of the discussions early so that you can kind of avoid some of that.
Exactly. On the waterfront, I mean, we've had a couple of podcasts on water and constituent minerals and all the things, with lithium and turbride and things like that. Are you guys starting to see scenarios where you're addressing that, ownership of constituent minerals and things like that through water? Say if there is a water disposal component to it, what are you advising your clients? How are you guys addressing that, or has it become a thing yet?
Yeah, John, we were talking about this just the other day, right?
Yeah. So, there's, as the technology's improved to be able to, some people call it polish the water, right? Make sure you extract all the skim oil, extract all the lithium. Water midstream companies, may are starting more and more to put sort of directed delivery requirements into their contracts, which is to say that, look, you can utilize your standard, separator equipment at the tank battery, but after that, like, the water needs to come to us. You can't, do any of this. You can't do this extra polishing, any of that. Or if you want to, the rate that we've, proposed to you in the term sheet is going to increase by 20%, right? And so it's a dollars game at that point. University lands. This is on their website. With their contract for area developments, they have language in there that, hey, UL retains the right to essentially polish the water, or contract with a third party to polish the water before you send it to a third party disposal.
Yeah. Well, I think we're certainly going to continue to see the value of that water rise. I mean, originally the value, I'm thinking, over the last 6-8 years was just, I need water, and you can recycle that water in parts of Texas, or the aquifers are depleting and things like that. So water was valuable. Now it's exponentially more. I don't think anybody really understands how much more valuable it's going to be. But the takeaways is to always try to account for that in your transactions. Make sure if you do think there's value there, try to account for it. It just adds another wrinkle, right? Another complication.
Yep.
People ask us all the time, well, tell me about how you do due diligence. I said, tell me about your project. Tell me about the trade.
Yeah.
Tell me about, the assets and where it is. And every project is a new formula. I think you have to take your circumstances and be open-minded to how you go about it. And God, y'all's guidance today and your stories that you could tell are just reinforce that for sure. Guys, thank you so much for joining us today. A lot of good takeaways. It's always great to have resources like you guys to help guide us and things like that. If people want to reach out to you, how can they find you?
Well, we're just on the Bracewell website. You can just Google the firm or Google Austin Lee or John Stavinoa, and it'll come up and get our emails, and we're right there to help.
Awesome.
Excellent. We'll link to that stuff in the show notes. But yeah, thank you guys for joining us. It's been a pleasure.
Likewise. Right, y'all.
Appreciate it, guys.
Enjoyed today's topic? Follow us on Spotify, Apple Podcasts, and YouTube. Learn more at dudley-land.com. See you next episode.